Joining us right now is Stephen Parker. He is co-head of global investment strategy at JPMorgan Private Bank. And Stephen, you think that the gains for the market are likely to continue. I think your base case for the end of the year is 7,800, but your bull case, which you say is not much of a stretch, would be 8,900.
It is, yeah. I mean, the rally that we've seen this year has been entirely earnings driven. Even the most bullish expectations have been consistently exceeded, and we think that earnings momentum is going to continue into the end of the year. So if you look at our base case target, that's actually implying lower multiples from here. If you even get multiples that stick where they are with that earnings growth, that 8,900 number is achievable.
That's some pretty impressive growth following what we've already seen to be strong gains. What do you think drives that, and then what potentially gets in the way?
So the big thing that's driven it so far, as I said, has been earnings. And a lot of that has been the tech story. It's been the AI-related CapEx boom that we're seeing. But what's interesting and what's important for that bull case to play out is to see a broadening. And there are expectations that 8 of the 11 sectors in the S&P are going to deliver double-digit earnings growth. So I think if that continues, if we see that broadening, that's what gets us to the upside. The thing that would make us more nervous, one, would be a slowdown in the CapEx story, but we don't see that happening. The bigger risk would be if all of a sudden it wasn't the fundamentals, but rather optimism, exuberance, animal spirits creeping in. That would make us nervous. If multiples became a bigger part of the growth story rather than earnings, then we'd probably get a little bit more concerned.
You know, you hear things around the edges, like the idea that the cost that we've seen for memory chips spreading into other areas. Does that not worry you, or is that just a sign of the incredible growth?
I think it's a sign that there's just tremendous demand out there. And you know, you look at one of our top calls this year was around emerging markets, and obviously Asia, Korea, Taiwan, that chip story has been a huge part of it. And emerging markets are up 30% this year, but emerging market earnings growth is expected to be up 50%. So, yes, there are some bottlenecks that are creeping in, but that's a sign of healthy demand. We're going to have to watch how those bottlenecks end up playing out.
Why do you think this has been a not very loved rally at this point? I guess part of it was the Strait of Hormuz being closed, real concerns about what could happen from a geopolitical perspective.
Yeah.
And maybe not paying as much attention to the earnings as a result.
Well, I think that there's been just a slew of nonstop headlines, not just this year, but over the last couple of years, whether it's politics, geopolitics, energy prices, concerns around an AI bubble, concerns around what industries AI may disrupt, like with what we saw in the software sector. There's been a constant barrage of distractions for investors. But the thing that we continue coming back to is the earnings results, and the earnings continue to push higher. And that's, in the long run, what ultimately ends up driving markets.
So why do you think financials have not performed as well lately?
So financials have been an interesting laggard. So far year to date, earnings growth actually has been improving. Expectations have been moving higher, but the sector is actually down on the year. I think it's a list of concerns. So one, you've got concerns around what's happening in private credit. Two, you have concerns around what energy prices may do to consumer demand for loans. And then three, there's concerns around AI disruption and what it might do for parts of the financial sector, like insurance. But at the end of the day, when you look at the opportunity, particularly in parts of the sector like banks, it's really that loan demand that is the ultimate driver. And what we're seeing is, despite all of these headlines, loan demand remains robust, and that laggard, we think, is an opportunity.
So what else are you potentially concerned about, aside from just the idea of animal spirits picking up and valuations rising even beyond what the earnings would suggest they should?
You know, we're concerned about, the potential overheating from sentiment perspective, as we said. We were concerned, and we were watching closely what was happening with energy markets and the impact on the consumer. Mm-hmm. Our base case was that we were going to get a de-escalation, energy prices would come down. That's what we saw. But the headwinds that come from those higher energy prices are a risk. The other thing, when you watch the consumer, which has remained very robust, very resilient, some of the stimulus and the tailwinds that came from policy, higher tax refunds in the first half, those things are going to begin to fade. So we need to keep an eye on that. And then what's going to happen in labor markets? We've seen a nice recovery recently in the labor markets. If we see some weakness there, again, those are things that could be headwinds to the consumer, which we know is critical to the continuation of the story.
You didn't mention the Fed at all. And there's been obviously a significant change with the new chairman at the Federal Reserve. What did you think of his performance last week, what he had to say, and what the Fed could potentially do?
Yeah, so we don't think that there's going to be a massive change in policy policy.
Rates.
In rates. Yeah. Markets are pricing in something like 1.5 to 2 hikes by the beginning of next year. We think that they're probably on hold as we wait and see whether the reduction in energy prices take some of the heat off of inflation. I think what's going to be
on hold is okay for your
on hold. On hold is okay for our base case, and in fact,
bull case too,
and the bull case as well. I think markets can withstand a couple of rate hikes here. We've seen expectations move from 3 cuts to 2 hikes, and the earnings story hasn't been derailed. We think that can continue to play out. What's going to be more interesting, and the bigger policy shift that we saw from the meeting this week, was this idea that the statements are going to be shorter, the dot plots may not be as in focus, and that transparency that's been a hallmark of the Fed for the last decade, some of that may be pulled back. So that's going to increase a little bit of the volatility around policy, but we don't think we're going to see anything that throws off this bull market.